There's a point in almost everyone's financial journey where the whole thing starts to feel different. Not because they suddenly become rich, not because they find some secret investment that triples overnight, and not because they wake up one morning with a seven-figure net worth and a beach house. It feels different because at a certain point, money stops depending entirely on you and starts doing some of the work itself. That is the moment most people are chasing, even if they don't know how to describe it. It's the moment when saving stops feeling like pouring water into a bucket with a hole in it. The moment when your investments start growing by amounts that actually get your attention. The moment when you realize your portfolio made more in a month than you personally contributed. And eventually, the moment when your money is capable of covering parts of your life that used to depend entirely on your labor. That's when money starts working for you. And here's the frustrating part. Most people quit before they ever reach it. Not because they're lazy, not because they're stupid, and not because the math doesn't work. They quit because the early phase feels painfully slow. They save, they invest, they try to be responsible, and after a few years, the results still don't look dramatic enough. The numbers move, but not enough to feel life-changing. So they assume wealth building must be for people with big salaries, rich families, perfect timing, or some magical level of financial discipline they don't have. But that's the exact misunderstanding that keeps people stuck. Because money does not look impressive in the beginning. It looks boring. And that's what this video is really about. It's about understanding the exact point where money starts working for you, why that shift happens, and why most people give up during the stage when the process is still invisible. Because if you understand where the turning point is, building wealth stops feeling like blind faith and starts feeling like something you can actually trust. When most people think about making progress financially, they imagine a straight line. You put money in, your balance goes up. You put more money in, it goes up more. And the whole journey seems like it should be directly tied to how much you're personally able to save. That sounds logical. It's also the wrong mental model, because real wealth building is not linear. It's exponential. In the beginning, you do almost all the work. You earn the money, make the sacrifices, create the margin, and contribute the savings. Your portfolio is basically just holding what you put into it with a little extra growth on top. But over time, the growth starts creating more growth. The returns begin earning returns of their own. And eventually the balance becomes large enough that those returns stop feeling theoretical and start feeling real. That is the whole game. Not getting rich instantly, not picking perfect stocks, not outsmarting the market. The game is surviving the slow phase long enough to reach the phase where compounding becomes visible. And most people underestimate how important that distinction is, because in the early years, you're the engine. Your contributions matter far more than your gains. If you stop investing, progress basically stops. The machine isn't powerful enough yet to carry much weight on its own, but later, the machine starts helping. Then, eventually, it starts doing meaningful work. And once that happens, your relationship with money changes forever. Let's make this real with simple numbers. Say you invest $500 a month into a diversified portfolio and earn an average annual return of 7% over the long term. That's not a guarantee, and markets are never smooth, but it's a useful planning assumption. At that pace, you're investing $6,000 a year. In the beginning, the progress feels modest. You hit $10,000 and it feels nice, but not transformative. You hit $25,000 and it still feels small. Even at $50,000, a lot of people look at the number and think, I've been doing this for years, and this is it? That reaction is normal, because at this stage, your money is not really working for you in a meaningful way yet. It's helping a little, but you're still doing nearly all the heavy lifting. That's why the first major tipping point matters so much. The first real point where money starts working for you is around your first $100,000. Now, depending on your contribution rate, your returns, and your timeline, that number could come faster or slower. But the principle stays the same. At $100,000, your portfolio becomes large enough that average annual growth starts turning into real dollars. A 7% return on $100,000 is $7,000. That means your portfolio can grow by more in a decent year than the $6,000 you're contributing yourself. Read that again. Your money is now contributing more than you are. That is a huge threshold. Before this point, it feels like you are dragging your money uphill. After this point, it starts to feel like your money is finally pushing with you. Psychologically, this is where people stop treating investing like a chore and start seeing it as a machine. Because once your portfolio can generate gains that match or exceed your annual contributions, compounding stops feeling like some abstract concept from a finance book. You can see it happening. This is why so many people say the first $100,000 is the hardest. Not because every dollar after that is easy, but because the first $100,000 is where the system becomes believable. Before that, success requires faith. After that, success starts producing evidence. And that evidence changes behavior. You're more motivated to stay invested. You're less tempted to panic over short-term fluctuations. You're more likely to keep contributing because you can finally see the engine starting to run. But here's the part most people misunderstand. When you reach $100,000, you're not just 10% of the way to $1 million in any practical sense. You've already crossed one of the hardest parts of the journey. The stage where almost everything depends on your own labor and almost nothing comes from momentum. That's why the next phases often feel faster. Once you get to $100,000, the road to $200,000 tends to feel very different from the road to the first $100,000. Same person, same monthly contribution, different math. At $200,000, that same 7% return becomes $14,000 a year. Now your portfolio isn't just helping, it's clearly carrying more weight than your own savings. This is where the second shift starts happening. If the first tipping point is where money starts helping you, the second is where it starts changing your life. For many people, that happens somewhere between $300,000 and $500,000. Why that range? Because at that level, the annual growth from your investments can begin to affect real-world choices. Take $400,000 as an example. At 7%, that's about $28,000 in annual growth on average. Again, not every year. Markets are messy. But over time, that's the rough scale we're talking about. And $28,000 is not a side detail. That's rent in many places. That's groceries, utilities, insurance, and a good chunk of everyday life. That's enough to soften the impact of a layoff, buy time during a transition, or make a major decision without feeling financially trapped. This is where money starts doing more than growing. It starts creating options. And that is what real wealth actually buys. Not just more stuff, not just nicer brands, not just a more impressive lifestyle. Wealth buys breathing room. It buys the ability to leave a bad situation without your entire life collapsing. It buys the ability to wait instead of rushing into the next paycheck. It buys the ability to think strategically instead of desperately. This is the point where many people first experience a major drop in financial fear. They may still work full-time. They may still budget carefully. They may still be building. But they are no longer relying only on their own labor to hold everything together. They have a second engine now. And once you have a second engine, your whole posture changes. You negotiate differently. You take fewer bad opportunities out of panic. You become harder to pressure. You start making decisions from preference instead of pure necessity. That is a profoundly different way to live. Now, none of this means you should start spending recklessly just because your net worth reaches a certain number. In fact, this is often where people make one of their biggest mistakes. They finally see meaningful growth, and instead of respecting the boring process that got them there, they start chasing excitement. They take on more risk than they need to. They try to speed things up. They get impatient right when patience is starting to pay. That can be incredibly expensive. Because the boring strategy that gets you to this stage is often the same strategy that gets you through it. Consistency is still the edge. Time is still the edge. Staying invested is still the edge. Which brings us to the third tipping point. If $100,000 is where money starts helping you, and $300,000 to $500,000 is where it starts changing your options, then around $1 million is where money starts carrying real weight. At $1 million, a 7% long-term average return is about $70,000 a year. That doesn't mean you can safely spend $70,000 every year forever. That's a different conversation. Sustainable withdrawal rates are more conservative than average returns because markets don't deliver smooth results on demand. But in terms of what your capital is capable of producing over time, 1 million is a fundamentally different category from the earlier stages. At that point, your money is not just participating in your life. It is a major economic force inside your life. A strong year in the market can equal a full salary. A normal year can create more wealth than many people are able to save through work. Even a modest portion of that portfolio's long-term output can begin supporting actual living expenses. This is where people often experience the deepest psychological shift. Because when your invested assets reach this scale, time starts feeling different. Before this stage, the pressure is usually constant. Earn more, save more, push harder, catch up, keep going. After this stage, the pressure often eases, not because life becomes easy, but because your portfolio is now doing enough work that your future no longer depends entirely on how hard you can personally grind. That changes the way you think. You become more protective of capital. You start seeing money not just as something to spend, but as something that can produce future freedom. You understand that every invested dollar is like a tiny worker that can keep generating value for years if you don't pull it out too early. And that mindset is what separates people who briefly touch wealth from people who continue building it. Because the truth is, compounding gets more powerful the larger the base becomes. A 10% return on $10,000 is nice. A 10% return on $100,000 gets your attention. A 10% return on $1 million changes your year. That is why later stages of wealth building can look almost unfair from the outside. In the beginning, effort dominates. Later, capital dominates. And the people who understand that are much less likely to sabotage themselves during the boring years. Now, whenever people hear this kind of message, a few objections come up immediately. What about market crashes? What about inflation? What if I can't invest $500 a month? What if I'm starting late? Those are all fair concerns. First, market crashes. Yes, they happen. Sometimes badly. But if you're still in the wealth building phase and contributing regularly, falling markets are not just painful. They also mean you're buying more shares at lower prices. That doesn't make downturns fun, but it does mean they are not automatically the enemy of long-term investors. In many cases, they are part of what makes future growth possible. Second, inflation. Inflation absolutely matters. $1 million today does not buy what it used to. But that doesn't make these milestones meaningless. It just means you should think in terms of purchasing power, not ego. The point is not to worship round numbers. The point is to reach the scale where your assets produce meaningful economic output. Third, what if you can't invest $500 a month? Then start with what you can. The exact amount is not the lesson. The lesson is that consistency plus time eventually changes the role money plays in your life. Whether you start with $100, $250, or $500, the mechanism is the same. The timeline changes, but the principle doesn't. And finally, what if you're starting late? Then the answer is not despair. The answer is clarity. You may need a higher savings rate. You may need more intentional lifestyle choices. You may need to be more realistic about the timeline. But starting late is still infinitely better than never reaching the turning point at all. Because the biggest mistake is not starting imperfectly. It's staying stuck because the perfect setup never arrived. So when does money start working for you? Earlier than most people think, but later than most people hope. It starts quietly. It becomes visible around your first $100,000. It becomes meaningful when your portfolio growth starts changing your choices. And it becomes undeniable when your capital grows large enough to support parts of your life without constant help from your labor. If you want the simplest version, it looks like this. At $100,000, money starts helping you. At $300,000 to $500,000, money starts changing your options. At $1 million, money starts carrying real weight. That's the arc. And once you understand that, building wealth stops feeling like some fantasy reserved for other people and starts feeling like a process with recognizable stages. You don't need instant proof. You need patience long enough to reach the point where the machine begins doing what machines do: multiply effort. That's what most people never experience. Not because it's impossible, but because they give up in the quiet years. They mistake slow beginnings for failed strategy. They confuse boredom with lack of progress. They assume that if the process doesn't feel exciting, it must not be working. But some of the most important financial progress you will ever make looks unimpressive while it's happening. That's why patience matters so much. Not because patience makes you morally better. Not because suffering is noble. But because wealth is often built in a way that hides its rewards until the foundation is already in place. And one day, if you keep going, you'll hit the point where you check your accounts and realize something has changed. Not in the headlines, not in the economy, in the relationship between you and your money. It is no longer sitting there. It is working. And once that starts, the entire game feels different.